Welcome to my channel. Have you ever wondered why a corporate behemoth boasting billions in net profit and flawless annual reports can suddenly collapse into bankruptcy overnight, leaving tens of thousands of employees unpaid and millions of investors destitute? We are conditioned to believe that the financial statements published by publicly traded companies represent absolute truth, assuming that a surging profit margin is the ultimate indicator of corporate health and future prosperity. Yet, beneath this carefully curated facade lies a terrifying paradox that routinely annihilates the wealth of unsuspecting retail investors. What if the very numbers you rely upon to make your most critical financial decisions are nothing more than elaborate illusions engineered by masters of capital manipulation? Today, we will embark upon a deep, methodical autopsy of corporate profitability, stripping away the glamorous disguises of the stock market to reveal the cold, unforgiving mechanics of financial survival and destruction. We will deconstruct the dangerous hallucination of accounting profit, exploring why a company can simultaneously report record-breaking earnings while slowly bleeding to death from a complete exhaustion of actual cash. We will expose the intricate machinations used by corporate executives and institutional insiders to manufacture a narrative of unstoppable growth, luring the gullible public into a predatory trap designed exclusively for the extraction of their hard-earned savings. To understand the pervasive deception of the modern financial ecosystem, we must first radically redefine our conception of profit. In the intricate world of corporate accounting, net profit is not a tangible asset that you can withdraw from a bank vault. It is merely a mathematical opinion subject to infinite interpretation. The foundation of this opinion rests upon the accrual basis of accounting, a system where revenue is recognized the moment a transaction legally occurs, regardless of whether a single cent of actual currency has exchanged hands. Imagine that you have invested your entire life savings into opening a highly popular beverage store in the bustling heart of the city. Business appears spectacular, with customers flooding your establishment from dawn until dusk, and by the end of the month, your ledger indicates that you have sold 100,000 beverages. According to your profit margin calculations, you have generated a magnificent net profit of $50,000, prompting you to celebrate your inevitable ascent to financial freedom and entrepreneurial supremacy. However, when the time arrives to pay your landlord the monthly rent and compensate your exhausted employees, you open your cash register only to discover a dismal total of $1,000. A frantic investigation reveals that 99,000 of your beverages were purchased by familiar customers who provided written promises to settle their debts upon receiving their next paycheck. On your glorious financial statements, these promises are elegantly recorded as accounts receivable, inflating your profit while your actual bank balance remains dangerously close to zero. This excruciating scenario represents the most fundamental truth of commercial reality, demonstrating precisely how retail investors are systematically slaughtered. In the capital markets, if your landlord demands immediate payment and your suppliers refuse further credit, your thriving enterprise will suffer a sudden and catastrophic liquidity rupture, plunging you into unavoidable bankruptcy despite your staggering paper wealth. This is why the most enduring and unbreakable law of the financial world decrees that profit is merely an opinion, while cash remains the only undeniable fact. Yet, when the vast majority of ordinary individuals attempt to evaluate the potential of a publicly traded corporation, their initial instinct is always to fixate blindly upon the net profit or the earnings per share. The financial media amplifies this cognitive trap, publishing sensational headlines emblazoned with bold red font, screaming that a specific company has increased its annual net profit by 300%. This relentless bombardment of positive reinforcement creates a powerful psychological illusion, convincing the masses that they have discovered a guaranteed pathway to boundless wealth. This fixation on surface-level profitability cultivates a dangerous environment where greed entirely eclipses rational analysis. Retail investors, driven by the fear of missing out on the next monumental market surge, willingly surrender their critical thinking faculties to the comforting embrace of a carefully fabricated corporate narrative. They observe the surging stock price and the flawless profit trajectory, convinced that the ascending graph represents the intrinsic value of the enterprise, remaining blissfully ignorant of the hidden rot consuming the foundation of the company. Chapter Summary. The fixation on accounting profit creates a dangerous cognitive illusion that blinds investors to the true financial health of a corporation, ultimately leading to catastrophic wealth destruction. Chapter 2. The Truth of Cash Flow and the Lifeblood of Survival. To penetrate the elaborate camouflage of corporate earnings, we must shift our focus from the manipulated realms of the income statement to the unforgiving reality of the cash flow statement. Specifically, we must direct our absolute attention to the metric known as net cash flow from operating activities, which serves as the ultimate lie detector in the realm of financial analysis. This crucial indicator measures the exact amount of genuine currency that a company successfully extracts from the market exclusively through its core business operations. Operating cash flow does not include the fleeting capital acquired by assuming massive debts from sympathetic banking institutions, nor does it encompass the desperate funds generated by liquidating antiquated factories and obsolete machinery. It solely quantifies the authentic hematopoietic capacity of the enterprise, revealing whether the corporation actually possesses the fundamental vitality required to sustain its own existence. When a company reports $10 billion in net profit while simultaneously displaying a negative operating cash flow, it signals an imminent and terrifying financial apocalypse. This terrifying divergence signifies that the corporation is not only failing to collect any genuine currency from its operations, but it is actually hemorrhaging real wealth simply to keep the illusion alive. Imagine an individual dressed in impeccably tailored designer suits, flaunting luxury timepieces and frequenting the most exclusive private clubs, projecting an aura of unimaginable affluence. Yet, if we were to examine this individual's bank accounts, we would discover an absolute balance of zero, alongside a mountain of exorbitant credit card debt used exclusively to maintain the charade. How long can such a precarious existence be sustained before reality inevitably reclaims its toll? Let us examine a historic example involving a prominent landscape engineering behemoth that once captivated the entire stock market. During its golden era, this company represented the ultimate growth story, with analysts endlessly extolling its virtues as revenue skyrocketed by billions of dollars each consecutive year. Its net profit surged exponentially, reaching a staggering peak of over $2 billion annually, igniting a fervent buying frenzy among institutional and retail investors alike. However, any prudent investigator who bothered to scrutinize the cash flow statement during this period of euphoric triumph would have experienced profound terror. In the exact same year that the corporation declared $2 billion in pristine net profit, its operating cash flow plunged into a catastrophic deficit exceeding $1 billion. This massive discrepancy revealed that despite operating countless massive municipal projects nationwide, the company was collecting virtually no actual compensation, forcing it to subsidize its explosive growth entirely out of its own depleting reserves. The corporation's business model required immediate and massive expenditures for seedlings, heavy machinery rentals, and labor compensation, while municipal clients demanded decades-long repayment schedules that slowly transformed into uncollectible accounts receivable. To plug this expanding black hole of liquidity, the management resorted to frantic borrowing, issuing high-yield corporate bonds, and pledging a vast majority of the founders' equity for margin loans. They substituted missing operating cash with perilous financing cash, dancing recklessly upon the edge of a volcanic eruption of exponential debt. Chapter summary: Operating cash flow is the unforgeable truth of corporate survival, and any massive divergence between paper profit and real cash generation signals an inevitable plunge into liquidity collapse and absolute ruin. Chapter 3: The architecture of deceit and 3 tricks of financial magic. If gross discrepancies between cash and profit so clearly predict corporate mortality, how do the master architects of financial fraud continually evade detection by millions of market participants? The answer resides in the sophisticated application of 3 pervasive methodologies designed to artificially inflate earnings while obscuring the underlying rot. The most prevalent technique is the fabrication of paper wealth through the aggressive expansion of accounts receivable. Unscrupulous executives will establish an intricate network of shell companies disguised as legitimate clients to absorb massive quantities of unsellable inventory. Once these fictitious transactions are formalized with legally binding contracts, the corporation instantly books hundreds of millions in unearned revenue, sending the net profit soaring and triggering jubilation among naive investors. Yet the purported clients have not remitted a single dollar, resulting in a massive accumulation of worthless IOUs on the balance sheet. The company expends genuine resources on raw materials and labor to manufacture products that effectively disappear into a void, culminating in a severe liquidity crisis hidden behind a flawless earnings trajectory. Eventually, when the insiders have successfully liquidated their overvalued shares at the apex of the market hysteria, the company executes a devastating maneuver known as the big financial bath. The management suddenly announces that the major clients have experienced unforeseen insolvency, necessitating a massive write-off of the enormous accounts receivable balance. Overnight, billions of dollars in fabricated profits are vaporized, replaced by an unfathomable deficit that instantly triggers a limit-down avalanche in the stock price, exterminating the wealth of the retail investors trapped within the inferno. The second nefarious strategy frequents the consumer goods and electronics sectors, where it is eloquently termed channel stuffing. Towards the conclusion of the fiscal year, desperate executives facing the imminent failure to achieve promised growth targets will ruthlessly coerce their vast networks of distributors into purchasing excessive quantities of inventory by offering extravagant future rebates or extended repayment terms. The corporation forces millions of smartphones or garments out of their central warehouses and into the basements of reluctant retailers, instantly recognizing triumphant revenues and record-breaking profits. The unfortunate reality is that these commodities have never reached the hands of actual consumers. They have merely been relocated to gather dust in a different geographical location. Since the distributors incurred debt to acquire this unwanted merchandise, the mother company endures a severe hemorrhage of operating cash flow while basking in the glow of fabricated prosperity. When the inevitable economic downturn arrives and the merchandise becomes utterly obsolete, the corporation will shamelessly maintain these worthless assets at premium valuations on the balance sheet, perpetuating the illusion until insolvency implodes the structure. The third and perhaps most insidious technique operates entirely within the bounds of legal accounting frameworks and is rampant among purportedly innovative technology companies. The capitalization of research and development expenditures. Imagine a software behemoth disbursing $1 billion in salaries to its elite cadre of algorithms engineers. According to conservative accounting principles, this massive outflow should immediately decimate the current year's profitability. However, a creative chief financial officer can convince the auditors that these salaries represent the creation of a revolutionary proprietary system destined to generate infinite future wealth. Upon receiving auditory approval, that billion-dollar outflow miraculously evaporates from the income statement and materializes on the balance sheet as a majestic intangible asset. Consequently, a company experiencing a genuine $800 million deficit from core operations will triumphantly report a $200 million net profit to the unsuspecting market. The cash has indeed vanished from the corporate treasury to compensate the workforce, but the earnings statement shines with an unblemished brilliance, allowing the narrative of technological supremacy to flourish unhindered by the dreary shackles of financial reality. Chapter summary. Corporate executives deploy sophisticated accounting illusions, such as accounts receivable manipulation, channel stuffing, and expense capitalization, to manufacture a mesmerizing facade of growth while concealing terminal liquidity exhaustion. Chapter 4. The scam of non-recurring gains and the zombie enterprises. When the aforementioned manipulations can no longer camouflage the total atrophy of a corporation's core operations, the architects of deception resort to measures that border on the absurd. We now enter the twilight zone of the capital markets, where a multitude of terminally ill enterprises rely exclusively upon the Venus drip of non-recurring gains to prolong their pathetic existence. These entities have utterly failed at manufacturing competitive products or providing valuable services, yet they continuously produce annual reports, showcasing hundreds of millions in dazzling net profit. Consider the bizarre tale of a legendary automobile manufacturer that had plunged into such severe operational turmoil that consecutive years of colossal deficits placed it on the precipice of mandatory delisting. As the despairing shareholders awaited the inevitable extermination of their capital, a miracle mysteriously materialized. The company abruptly released an earnings report showcasing a spectacular return to profitability, eliciting ecstatic cheers from the ignorant masses who believed a groundbreaking technological revolution had resurrected the brand. The harrowing truth, however, resided deep within the opaque footnotes of the financial disclosures. This purported automotive giant had not experienced a resurgence in vehicle sales. Instead, it had rescued its corporate shell by liquidating more than 400 residential properties within a few frantic months. By transforming itself from a struggling car maker into the nation's most prolific second-hand real estate agency, the company injected enough desperate liquidity onto its balance sheet to artificially propel its net profit back into positive territory. Retail investors seeking exposure to advanced manufacturing were actually purchasing shares in a hollow entity, rapidly cannibalizing its final remaining assets just to survive another year. An even more prevalent methodology for artificially sustaining brain-dead corporations involves the shameless reliance on substantial government subsidies. Picture a failing traditional apparel manufacturer plagued by unsellable inventory and perpetual deficits, which suddenly announces a radical pivot towards the euphoric sector of renewable energy. Almost concurrently, the company reports a surging net profit, igniting speculative hysteria among retail traders convinced they have discovered the next exponential multiplier. In the stock market, The soaring share price traps countless novices in a frenzy of unrestrained greed and exhilarating expectation. Yet, a prudent analyst examining the deducted non-recurring net profit metric would discover a terrifying void. The core operations exude an unfathomable deficit, revealing that the fabricated prosperity originates exclusively from massive financial incentives, prematurely awarded by local governments, eager to attract high-technology investments. When the corporation inevitably fails to deliver the promised technological breakthroughs due to a complete absence of technical expertise, the enraged authorities demand the immediate restitution of the subsidies. This single administrative edict instantly unplugs the financial life support, plunging the stock into an endless sequence of limit-down apocalypses. Perhaps the most comical yet devastating variation of this deception manifests in companies deemed the kings of dereliction of duty. These veteran enterprises have long abandoned their original industrial mandates, choosing instead to deploy their remaining capital reserves, including funds borrowed exclusively for purported expansions, into the highly volatile realms of equities and speculative wealth management products. During euphoric bull markets, their unhinged speculations yield enormous investment returns, propelling their stated net profit upward by monumental percentages and deceiving the public into believing they represent prime value investments. When the inevitable bear market ravages the speculative arenas, these same corporations suffer catastrophic annihilation, witnessing their profits vaporize into staggering deficits, defying rational comprehension. Unwitting investors who believed they were participating in the steady growth of a solid industrial enterprise suddenly discover they possess shares in a highly leveraged, unregulated mutual fund disguised as a manufacturing entity. The ultimate weapon disarming these elaborate schemes is the indicator known as net profit after deducting non-recurring gains, which strips away the subsidies, the asset sales, and the casino winnings to reveal the raw, unfiltered truth of corporate vitality. Chapter Summary. Desperate corporations utilize absurd strategies like mass asset liquidation, subsidy exploitation, and stock speculation to manufacture false earnings, requiring prudent investors to rely exclusively on deducted net profit to discover true operational health. Chapter 5. The collapse of earnings quality and the psychological abyss. When we understand the profound difference between the flamboyant facade of total net profit and the somber reality of deducted net profit, we gain the ability to detect the most ominous warning signal in the entire financial ecosystem: the divergence of earnings quality. When a publicly traded corporation showcases a consecutive multi-year expansion in its headline profitability while its deducted net profit simultaneously contracts or hemorrhages into negative territory, it emits a blaring air raid siren that institutional investors recognize instantly. The specific trajectory unmistakably signifies that the corporate entity has completely lost its intrinsic hematopoietic capability. This phenomenon is not a random anomaly. It is the meticulously orchestrated prelude to a predictable massacre. In the institutional trading algorithms, this divergence acts as the ultimate starting gun for a coordinated mass evacuation. Before the institutional titans abandon the sinking vessel, they frequently collaborate with unscrupulous financial media outlets to propagate sensational narratives extolling the superficial profit growth, manufacturing, an illusion of unprecedented prosperity. This deliberate disinformation campaign is designed to agitate the inherent greed of retail investors who remain oblivious to the rot festering beneath the surface. Why does the ordinary retail investor repeatedly plunge into this carefully laid snare? The answer resides deep within the psychological flaws of human nature, particularly the overpowering phenomenon known as the fear of missing out. When the novice investor observes a surging stock graph accompanied by screaming headlines announcing a 300% increase in net profit, their critical thinking faculties instantly evaporate. They are consumed by an intense anxiety that if they do not purchase the equity immediately, they will forever forfeit their only opportunity to achieve monumental wealth and societal status. This intense emotional agitation prevents them from engaging in the tedious, methodical process of examining the cash flow statement or scrutinizing the exact composition of the disclosed revenue. They purchase the illusion pushed by the capital architects, believing that the upward trajectory revalidates their genial intuition. They convince themselves that they are value investors discovering a hidden gem, when in absolute truth, they are merely fulfilling their predestined role as essential liquidity providers for the exiting whales. The entire architecture of the financial market exploits this asymmetric information structure to facilitate uninterrupted wealth transfer. To inoculate oneself against this systematic slaughter, an investor must master the ultimate golden metric, the net cash ratio, calculated by dividing the operating cash flow by the net profit. This formula serves as an infallible detector of authenticity. If the result exceeds 100%, meaning the cash flow surpasses the declared profit, it signifies a phenomenal enterprise, wielding absolute dominance within its supply chain, collecting hard currency while constraining its debtors. Conversely, a ratio plunging substantially below 50% reveals a dangerous enterprise surviving solely upon fictitious ledger entries and rapidly approaching a terminal liquidity exhaustion. When the unsuspecting investor ignores this paramount metric, they unwittingly step onto a precarious scaffold hovering above an abyss. They hold on desperately to their plunging equities, mesmerized by the historical illusions of high profits, repeating the mantra that the fundamentals are sound while the institutional capital vaporizes into the ether. They experience a profound cognitive dissonance, unable to reconcile the beautiful narrative promulgated by the corporation with the horrific reality reflecting within their own decimated brokerage accounts. This psychological paralysis ensures their utter and inescapable annihilation as the inevitable collapse unfolds. Chapter summary: Institutional predators exploit the divergence in earnings quality and the emotional vulnerabilities of uninformed retail investors to orchestrate massive wealth transfers prior to an inevitable corporate implosion. Chapter 6: The moment of crash and the capital slaughterhouse. The inevitable journey from fictitious prosperity to absolute ruin does not occur as a gradual decline. It transpires as a sudden, violent disintegration of reality. The tipping point arrives when the intricate web of subsidies, asset liquidations, and exploding accounts receivable reaches the absolute mathematical limit of sustainability. At this precise microsecond, the macroeconomic environment will generally experience a subtle contraction, prompting prudent financial institutions to reevaluate their risk exposure. When a major bank suddenly hesitates to roll over a substantial short-term loan due to glaring deficiencies in the operating cash flow, the death spiral initiates with terrifying velocity. The corporation, previously accustomed to plastering over its operational deficits with endless injections of external credit, suddenly finds the financing valve violently shut. With the cash reserves completely depleted and the maturing debt obligations demanding immediate satisfaction, the company defaults on a minuscule commercial paper payment. This seemingly insignificant failure instantly triggers cross-default clauses across its entire debt structure, transforming the sleeping giant into a frantic, hemorrhaging behemoth sinking into the mud. The facade of high-technology innovation or consumer dominance shatters entirely, exposing a rotting carcass devoid of any intrinsic value. On the trading floor, the disaster manifests as an apocalyptic event. The brokerage screens turn a menacing crimson as millions of sell orders flood the system with absolute urgency. However, the market is devoid of buyers. The shrewd institutional whales vacated the premises months ago, leaving only the astonished retail investors staring in paralyzed horror at their devices. The stock opens plunging into the limit down threshold, forming an impenetrable wall of desperation. The novice investor experiences a nauseating cocktail of denial, anger, and despair, frantically hitting the sell button to escape the inferno, only to discover that liquidity has utterly vanished. Day after day, the limit-down avalanche continues inexorably, vaporizing decades of laborious savings and shattering countless familial dreams. The retail investors who sincerely believed they were participating in the triumph of a thriving enterprise are now trapped within a financial abattoir, forced to witness the systematic eradication of their capital. The corporation inevitably commences frantic asset restructuring procedures, halting operations, and dismissing thousands of dedicated employees who are equally baffled by the sudden demise of the purportedly profitable colossus. The social tragedy unfolds with ruthless efficiency dictated entirely by the inflexible laws of capital. Perhaps most horrifying is the revelation that even companies displaying seemingly robust operating cash flows can harbor fatal contagions hidden within their investment cash flows. In the highest echelons of financial sorcery, a corporation may possess billions in actual currency deposited safely within prominent banking institutions. Yet, to the utter bafflement of the rational observer, the very same corporation continues to amass exorbitant amounts of high-interest commercial debt to sustain ordinary operations. This pathological contradiction, known as the high cash, high debt anomaly, invariably signifies that the ostensible bank deposits have already been secretly pledged or embezzled by the dominant shareholders. When this ultimate deception finally unravels, the consequence is total extermination. The billions in advertised cash are discovered to be phantoms, transferred through complex offshore shell companies to evade regulatory scrutiny while funding the extravagant escapades of the corrupt oligarchy. The enterprise defaults spectacularly, seeking immediate bankruptcy protection and abandoning the minority shareholders to the vultures of liquidation. This final paradigm of destruction proves that, in the predatory environment of public equities, every conceivable metric can be weaponized unless examined with the most ruthless and skeptical objectivity imaginable. Chapter summary: the inevitable collapse manifests as a sudden credit asphyxiation that traps uninformed retail investors in an illiquid nightmare, exposing the fabricated earnings and hidden embezzlements that destroyed the corporation. Chapter 7: Philosophical reflection and the nature of value. As we conclude this searing autopsy of financial illusions and capital carnage, we must elevate our perspective above the mere mechanics of accounting and confront the profound philosophical dilemmas permeating the modern financial system. What exactly constitutes true value in an ecosystem designed to perpetually manufacture hallucinations? Are we observing a rational market that efficiently allocates resources to rewarding innovation? Or are we staring into a colossal global casino where value is nothing more than a shared delirium, orchestrated by those who dictate the rules of the game? The real tragedy exhibited in the extermination of the retail investor does not emanate merely from a lack of technical financial acumen. It stems from a fundamental misunderstanding of capitalism's core nature. Ordinary individuals earn their wealth through tangible actions, producing physical commodities, expending time, and delivering verifiable services. Consequently, they project dishonest mentality onto the stock market, naively believing that A corporation demonstrating phenomenal accounting profit is honestly manufacturing corresponding wealth. They fail to realize that in the echelons of high finance, profit is a sculpted masterpiece, and the true product being manufactured is not goods, but share price itself. Investing, therefore, is not a passive participation in an inspiring story of corporate growth. It is a brutal, unrelenting cognitive warfare executed on a monumental scale. The winners in this arena are not necessarily those who possess superior moral character or virtuous intentions, but those who can ruthlessly pierce through the veil of fabricated data to perceive the raw, pulsating flow of genuine liquidity. They comprehend that a corporation is an intricate machine designed to extract cash from its environment, and the moment the machine requires artificial life support disguised as subsidies or inflated receivables, its existential value plummets to absolute zero. How does the individual survive and flourish amidst such pervasive deceit? True financial sovereignty can only be attained through the complete annihilation of ignorance and the rejection of emotional speculation. It demands the cultivation of a relentlessly skeptical mindset that questions every dazzling headline, interrogates every seemingly perfect annual report, and always seeks the unforgeable fingerprint of authentic operating cash flow. When we strip away our vulnerabilities to greed and our irrational fear of missing out, we immunize ourselves against the invisible predators seeking to plunder the fruits of our mortal labor. If this immersive exploration into the murky depths of corporate finance and human psychology has provided you with a searing clarity, I humbly request that you like this video and subscribe to my channel. Your continued support empowers us to relentlessly deconstruct the intricate illusions of the global economy and deliver the unvarnished truth demanded by a sane mind. As you prepare to examine your own investment portfolio tomorrow morning, attempting to discern the authentic from the artificial, I leave you with one deep, unsettling question to contemplate. Are the equities you currently possess anchored in the solid foundation of genuine cash creation, or are you unknowingly financing the extravagant delusions of a dying empire? Chapter summary: the financial market is not a benevolent arena, but a brutal landscape of cognitive warfare where survival requires the absolute eradication of illusion and a relentless dedication to authentic value.